What are syndicated loans and how is it beneficial to have this debt placement? Let's learn more. A syndicated loan is a loan wherein there is a single issuer but multiple group of investors. These multiple investors, also known as lenders, are subscribing either to the single bond issuance of the borrower, or they're collectively coming together and providing debt capital to the borrower. So why is this called as a syndicate? This is called as a syndicate because all the lenders, and these could include even high profile private credit funds, it could also include large banks, project finance companies, or even insurance companies who want to invest in debt like instruments. So all the lenders come together and they agree to take on the loan of a single borrower. The borrower is a single entity. The loan amount is a single amount, but typically runs into millions of dollars. But the lenders are slicing and dicing this loan into smaller portions according to their individual risk appetite. The syndicated loan has become a very large market in the last few years because the indenture and the loan agreements, along with the different covenants, the terms and conditions and restrictions, are similar to all the investors. Thus, if there's a large bond issuance running perhaps into millions of dollars or perhaps even touching the magical number of $1 billion called as a jumbo bond placement, we find that single lenders do not have the appetite to take on this large volume of debt in their books by way of an investment. So what does the banker do? They get in other bankers and they form a syndicate so that collectively the syndicate then invests in the debt of this single issuer. So the issuer is one, the loan amount is one, the interest paid also would be identical in terms of the coupon rate and coupon payment terms. And most importantly, the agreement, the terms of the conditions, the covenants of the indenture, everything would be identical for all the investors. But they're executing just one agreement with the lender. In this case, we find that many syndicates of investors come together and they appoint one lead banker, and the lead banker takes on the position of taking the lead for collateral management as well as for collecting all the documents needed for managing the collateral of the loan. The lead banker also charges lead banking fees because they are doing a lot of work with respect to collateral management on behalf of the rest of the investors in the syndicate. Syndicated debt placement, syndicated loans have thus become extremely important in large ticket transactions, in large value transactions running into millions of dollars, because it enhanced debt capacity for the issuer of the debt.